We already know how to prepare profit and loss account. We also know what it represents. The profit and loss account will show us how much profit or loss the business has made during a particular period. But is earning profit the same as earning cash? Let's say that you have purchased goods worth Rs 10,000 and have sold them at Rs 15,000. You have earned a profit of Rs 5,000 as per your profit and loss account. But does this mean that your cash or bank balance have also increased by Rs 5,000? Not necessarily. If the sale transaction is on credit, then your cash or bank balance have not increased at all, even though you are showing that you have earned a profit of Rs 5,000 in your profit and loss account. A business, in order to survive and grow, is not only required to have profits, but it is also essential that it must have cash balances. Let's say a business have made a profit of Rs 50 lakhs during an accounting year, but the major portion of this profit have come in the form of credit sales. In such a situation, it might be the case that although the enterprise have earned 50 lakhs of net profit, but it is not able to pay the rent of Rs 50,000 per month due to deficit in cash balances. This shows that earning profit is not the same as generating cash. To analyze the cash movement in a business or to ascertain the sources of cash and the application of cash, we prepare the cash flow statement. The cash flow statement shows the flow of cash and cash equivalent during a period of time. Cash equivalent are those items which are not actually cash but can easily be converted into cash. For example, bank balances or marketable securities. In this definition, the flow of cash means cash inflows, that is, cash coming into the business, or cash outflows, that is, application of cash or cash flowing out of the business. In simple language, transactions that increases the cash and cash equivalent balances are known as cash inflows, and the transaction which decreases the cash and cash equivalent balances are outflows of cash. Let's have a look at some of the examples of cash flows. Along with giving us information relating to movement of cash flow statement essentially provides a reconciliation between net profit that we get from profit and loss account or the income statement and what is the balance of cash in the company's balance sheet. Continuing with the earlier example, let's say the firm has made a profit of Rs 50 lakh during an accounting year. But the actual increase in cash from the previous year is Rs 30 lakhs only. Using cash flow statement, we can arrive at how we got a cash flow of only Rs 30 lakh when the actual net profit is Rs 50 lakhs. Keeping this logic in mind, the cash flow statement is prepared beginning with the net profit from the profit and loss account and it ends with the closing cash balance in the balance sheet. Cash flows in the businesses are of different types. Some cash flows could be normal business transactions like buying and selling of goods, and some cash transaction could be of other business transactions like buying and selling of fixed assets. Accordingly, the cash flow statement shows the movement of cash under three major heads: cash flow from operating activity, cash flow from investing activity, and cash flow from financing activities. Operating activities are the principal revenue producing activities of the enterprise. Principal revenue producing activities means the business activities which are carried out by the firm to earn profits. For example, buying and selling of goods by a trading company, or receipts from debtors or payment to creditors. Also, for a finance company like banking institution, giving and taking loans will be principal revenue generating activity. All the cash flows from these types of activities would be considered as cash flow from operating activities. Investing activities are the acquisition or disposal of long-term assets. These activities include transactions involving purchase and sell of long-term assets, that is, assets which are not held for immediate resale. These activities could be in the form of purchase or sale of fixed assets, purchase or sale of securities, for example, shares or debentures. These activities defines how a business or enterprise is financed. Financing a business could be in the form of owner's own equity or borrowings from outside parties. Thus, financing activities are activities which results in change in size and composition of owner's capital in the form of change in share capital and borrowings of the enterprise from other sources. Examples of cash flow from financing activities could be proceeds from issue of shares or debentures, proceeds from acquisition of additional borrowings from the bank, payment for buyback of equity shares, or repaying the amount of borrowings.